expandCFO.
Your revenue chart is up and to the right, but your bank account is begging for a break. Why? Revenue doesn't equal cash, especially when growth costs more than it returns upfront. A lot of e-commerce founders, they celebrate a sales spike like it's a huge win. And they should. But from my experience, this revenue boom can actually hurt cash flow, especially if it's not managed well. With this revenue bump, your P&L looks good, income's up, profits are up. Quickly, you can see your actual cash on hand in the bank can tell a different story. It's a good problem to have, but now you need to get serious about managing your cash. If you're not managing your cash flow well, then every spike in sales can mean you have more cash going out the door before it comes back in. Where do we usually see cash getting tied up when brands start scaling fast? The biggest use of cash is buying the inventory you need to sell. The longer the lead time between when you have to pay for the inventory you buy, the raw materials, and when you sell it to your customers, the worse of a cash flow crunch you're going to see, especially as the faster you grow as an e-commerce business. So if you don't have a lot of negotiating power with your suppliers, they'll make you pay a down payment up front, sometimes 100%. Sometimes it can take a couple months from that down payment to when they make your product and ship it to you. Sometimes shipping can take a while. You finally get the product in your warehouse, and then you turn around and sell it, and that's when you get paid. That can be a long time. The faster you're growing as a business, the more that hurts your bank account. The second area where we see cash being tied up when a brand is scaling fast is with your CAC, your customer acquisition costs. This is the money that you're spending to go acquire new customers. The more aggressive you are, the faster you're scaling, the more money you're spending up front to go acquire those customers. Let's say it costs you $500 to acquire a customer. That's through running various ads and other marketing and content. If they buy $100 of product from you every month at, let's say, 50% gross margin, it's going to take you 10 months to recoup that CAC, that customer acquisition costs. So you throw out $500 today, you got to wait 10 months to get it back to where you break even on that customer. After that, you're making ongoing profit for the lifetime of that customer. But for 10 months, you're just trying to get back to even. Now, if you're just doing one customer, it's $500, not a big deal. But if you're doing 10 new customers a month, that's $5,000 that you're outlaying this month that you won't see for 10 months. If you're scaling faster and you're adding 100 customers in a month, that's $50,000 you're going to burn in that month to add those customers. You can do the math however you want. The more aggressive you are with acquiring new customers, the more cash you need to fund it. So we've talked before about inventory as a silent cash trap. Now let's break down how a lack of ERP visibility turns inventory into a working capital black hole. Without a good ERP implementation, owners can underestimate how much working capital is trapped in their inventory. And by working capital, let's call it what it is, it's cash. Without clear visibility into sell-through rate, reorder timing, dead stock, slow-moving stock, you're basically flying blind on what you need to order. Follow-up question we're often asked is, what other kinds of metrics should a founder or COO be watching to avoid overbuying or getting stuck with dead stock? I'd say there's a few that come to mind that I think are the most important. And the first one I'm going to give you is a vanity metric that everyone thinks they need to track. And that is your overall days in inventory, or sort of a related metric called inventory turnover. When you look at that number and you look at it across all of your inventory, it's not really that helpful. It's just telling you on average, you turn over all of your inventory in a certain period of time, whether it's 3 months or 6 months. But that's usually not helpful. That's why I call it a vanity metric. What's more useful is break your inventory down into key product segments and then look at your inventory turnover for each product segment separately. That's where you get to start to see some trends. Certain items will move quicker, have a higher inventory turnover. Other ones are going to move more slowly, have a lower turnover. And looking at that, pairing with the gross margin, how profitable those items can be, can help you determine a strategy to decide what's more important to focus on in buying and making sure you have stocked well.
expandCFO.